Today we're going to talk about valuation. And everybody should know how to value a property. If you want to buy a commercial piece of real estate, what is it worth? You really need to understand income, income, income. That is the most important part of valuing a property. You're buying an income stream. Value in real estate is net operating income divided by a cap rate. We're going to talk about both net operating income and cap rates. That's how we're going to create value. Basically, net operating income is your gross revenue or your revenue less your vacancy, less your expenses. That equals net operating income. That's it in a nutshell. We're also going to provide a detailed example of one of the properties that we recently underwrote in Toronto, which is a fiveplex, which is an as of right zoning, very popular, good investment property type, brand new. We're also going to talk about cap rates, where they are in the spectrum of different places within Canada, within Ontario, and how that varies and why that varies. And it actually varies slightly by neighborhood too. So we'll try our best to do this, but this is where you need to understand these two things to be able to value a multifamily income property. So let's start with our example. We have a fiveplex in Toronto. This property happens to include in-suite laundry, doesn't include utilities, has parking available, and we're going to calculate the income based on that. These type of things matter though. So when you're looking at, when we're going to have a separate episode on market and rent and what you charge and how you evaluate that, but everything matters when it comes to rent. You need to find comparables. We're going to get into more detail. These units are renting for an average of $2,300 to $3,000 each. That gave us a total annual revenue of $162,000. We take off our vacancy, and that gives us what's called our effective gross income. Vacancy rate in Toronto is actually 0, but we always have to take off something because if you change over a unit, it's inevitable. So we use 2%. You might get away with 3%, depends where you are in Canada, but traditionally, vacancy rates are extremely low in just about any city in Canada. So 5 to 1 is a realistic vacancy rate in our cities. Then we take off expenses. The biggest expense in any is your property tax. Then your insurance, your hydro, your management, your replacement, your repairs and maintenance, your office, wages and salaries, advertising, leasing. These are the type of things that you have in your expenses. In our case, this totals about almost $30,000, or $28,590, and that gives us a net operating income of $130,000. In our particular example here, we're going to use a 4.5 cap rate, and we're going to end up with a value of $2.8 million. But there's a lot of research that goes into every part of this equation. You need to understand your income, you need to understand your vacancy rates, you need to understand your neighborhood, your market, and you need to understand even what's the going cap rates for your given area. While it looks pretty simple and it's not that hard, getting these numbers right matters, because if you're about to make a major investment, you need to pay at least the current market, because it's very hard to make back the money once you've bought it and you're into the property. We can also talk about another topic, which we'll do for a later time, is we can talk about how financing impacts this. We did talk about that initially. We're going to talk about cap rates. That's our next part of this. Whether you're in Toronto, Kitchener, Hamilton, Montreal, Halifax, Vancouver, whatever city you're in, each of those cities has its own cap rate dynamic, okay? Probably you're going to find the lowest cap rates in Toronto and Vancouver. It will be a toss-up to which of those communities at any given point has the lowest cap rates. So the lower the cap rate, the more valuable the income stream is. If you have a high cap rate, you're getting more bang for your buck in terms of purchasing income. You won't get as much value, but it's a much better buy if you happen to like the area. So if you're in Toronto versus, let's say, Halifax, you could see up to a 1 or 2% difference in your cap rate, which is pretty significant. But Toronto is much more of a liquid market. There's more people here, so that will justify how the cap rates work. So all of this matters. Fortunately, there are many good tools out in the marketplace. We like to use CBRE's cap rate survey. It's available to most people. I believe it's free. I think every major realtor has some version of this that you can look at. You're also going to need to contact a realtor likely in your area. If you're looking for a purchase, you need to deal with a reputable commercial realtor. They will know the specific transactions, or your appraiser might know the specific transactions that you have to do, what's going to happen to do the values. We're also going to talk about appraisals and building condition and all that in another video. But every little component we're going to talk to in our future videos actually matters. But we're going to give you the simplified overview here. So when it comes to cap rates, your area matters. The build form matters. So the age of your property matters. Even the neighborhood matters. You'll be getting better rents in better neighborhoods, and you'll actually probably get lower cap rates in better neighborhoods. So therefore, the income stream you're generating actually has the maximum value. Slightly different market, let's say Hamilton versus Toronto, you could see 75 to 1% the cap rate difference, even though Hamilton's only 45-minute drive from Toronto. That is how you do value in a nutshell, and stay tuned for our next video.